Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to dive into Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's just dive right in, take a look, see what's going on. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com. I dive deeper into all these topics and subjects, looking for potential investment opportunities that I share with everyone in the community. We do have a coupon code special. Special is the coupon code. If you like savings, and you can see in the description link the pricing of it. So, trader, we got Chevron. Chevron closed the week with a bullish continuation candle, showing buyers maintaining control as price approaches the resistance of its large symmetrical triangle high base. So this is a symmetrical triangle. You enter it from the top, from the downside upward. You consolidate inside of it where your range shrinks into a corner. And then most of the time it breaks to the upside. That is a symmetrical triangle from the bottom side up in a consolidation pattern. There's generally three humps. You can get one, two, three, and then this last lead in. Sometimes it breaks right out, sometimes it pulls back. It says identify the pattern with converging trend lines of lower highs and higher lows. Wait for a breakout confirmed by increased volume. Enter a long position on a bullish breakout or a short position on a bearish breakout. Place a stop loss just inside the triangle. Set a target by measuring the height of the triangle and projecting it. The height of the triangle is this first one here. So what I've seen a lot, here's Chevron's, you come from the downside up and you've been in this consolidation. What I've seen a lot going on is false breakdowns. So a lot of people read this technical analysis. They say, oh, go short when it breaks down like this. I've seen a whole bunch of times where it breaks down and then slingshots in the other direction. It's almost like AI or whatever, the robotic trading, whatever they are, they force and push things below the pattern purposefully and then get everybody jacked up. So what I would do and what I've done is I look at the fundamentals backing the technicals. Are we in a bullish formation? Are we in a bullish condition or environment for that sector or commodity or whatever it is? And then you want to look across a whole bunch of different charts. You don't want to trade just one chart. A lot of the times, there's ways that you can cheat the system, so to speak. The big guys are Chevron. So if we look at, say, like Chevron. Chevron is sitting on top of a pattern. So this is what it looks like on a big long-term view. You can see the orange circles there. Your consolidation is actually, this is your consolidation here. Coming off of this consolidation, we are in a new super cycle. That super cycle started in 2020 is the bottom. That's where it bottomed. And we are now in a wave one. I could move it over. There we go. Wave one, wave two pullback. And that's where I think we're going to eventually work our way on up. It's important to look at things from different time frames: long time frames, medium time frames, and short time frames. A long time frame is this view going back to 1970s. A shorter time frame is looking at it for 10, 15 years. And then a really short time frame is looking at it for the past 5 years. A lot of people, they zoom in and all they're looking at is like a 1 year chart. You can't see anything from a 1 year chart here. I mean, you're basically blind. And then people look at, minute charts and daily charts and whatnot. So this is what we're looking for, is the confluence of information on a long term, then on a shorter term, and then on a very short term. That's your bullish kind of looking at things. This here looks bullish because we've broken out of the consolidation here. to the upside, and we're consolidating on top of that pattern, the consolidation channel. Then you can look at other companies like ConocoPhillips. Look at the big long-term view here, and it's the same thing. This setup is the same setup that we experienced here. So we had a big consolidation from 1980, and we broke out of that in 88. So it was an 8-year consolidation there. This is from 2008, breaking it in 2021, which is a little bit longer consolidation, but it's the same thing. And then we've got the same type of fractal movement, and that's where we're located. Now, I can't tell you in the short term if we go down a little bit more or if we go up. Very difficult to see, but this is the big picture view. We also have confluence between Chevron and ConocoPhillips, and then you might want to go look at ExxonMobil and say, well, you know what, maybe I should look at ExxonMobil. Here, this one is a stronger company as the consolidation was consolidating upward. So it's going up and up and up and up. Here's your big consolidation here. Here's your bottom of the super cycle, and then here's your move on up, which is above support, and we've been consolidating on top of support. So that's confluence. That's what you want to do if you're trading. It increases your chances of success. So this line here, this consolidation, it depends where it consolidates. If you're consolidating coming off a bottom like this, that's pretty bullish. If you've fallen, and we don't have it on this chart here, but if you're falling and then you've got an upward move and it consolidates here, maybe it's just a halfway pattern where we go on up and then it rolls back over again in a big long-term downtrend. But it depends where it's at and what you're looking at. Here's Respeculator. It says, mining stock strategies as I see them. Most retail investors, they buy a bunch of less than 30 million explore companies that trade $20,000 to $50,000 per day, and maybe 1 in 20 hit and go 100 to 300%. Then 1 in 20 of them hit again for something like a legit 500 to 1,000% plus. You waste 90% of your capital on those that don't work for the 10% that go 20x. You tell your friends of that one that did 20x and ignore the others. The strategy as a whole yields 5 to 10% per annum. Big funds you follow, BHP, Rio, Freeport, etc. You believe in the hard asset AI build thesis and capture the 8 to 10% beta those majors provide. The other, which it's a big group, retail believe they can capture the next big discovery and 10x their money. There's a more boring but volatile space that can do this earlier, in my opinion, in other, each to their own. Good luck. So what I do, I don't prescribe to any of these approaches. There are lower risk, higher returning sectors and also companies within certain sectors, and then commodities that do very well with pretty big leverage that have very low risk and pretty good reward. So I actually don't follow, I don't put my money like the Explorcos. I do own some, and there's very few, and I've got a very strict approach to it. Like I'm not just buying anything and everything. And then the big funds, I don't really invest in a lot of the big funds. I have some of them, but I don't really invest in those either because they don't give you enough oomph. So I play between I don't I go into some of the developers, but it's not a ton. I would much rather pick cash producing companies, and then I look at the ones that have the leverage to the commodity. So they're medium to high cost producers. So they got the infrastructure in place. They are just out of cycle, and that's where your biggest returns can come from with the highest probability of success. So that's where I focus on, and that's what I share on the website are those types of companies. I do dip my toes a little bit in the explore companies, but it's not, they're not um, big, heavy allocations to them. And then, for discoveries, I mean, you're just rolling the dice here, guys. You're not really investing, you're just speculating. And you don't, the returns, it's hard to make a really good return um, buying companies that you're basically rolling the dice on. People like Peter Lynch and Warren Buffett would never invest in half of these companies. So I don't know why a lot of people put their entire portfolio in these explore companies. I don't understand that. I was looking at this. Jake says Coinbase, a big status quo change this week with the breakdown below the 9-6 pivot VWAP on Friday. So I like looking at these things and just seeing what people are seeing, and I see a different view. I mean, we're at support, so a lot of these things when you break out. So here's a shoulder, a head, and a shoulder. I actually talked about this on the website back in 22 and 23. You get a breakout from this. That's your bottoming pattern. You get basically a squeeze up on top of the pattern. This is your ideal entry points. Uh, and then you work your way on up. I don't see a topping pattern. We've got a downward facing pattern here again, and then we've got support going across here. So I understand a lot of people think this is going to probably dive down. I think it's kind of premature to say with certainty that that will be the case right now. So I think I'd like to see. I mean, if we think we're going to go lower, we got to break down. We got to break down, and yeah, I don't see any of those trend lines on that. If you notice, I look at these charts. I don't even put moving averages. I don't really look at the relative strength. Um, Relative strength can be seen by the big stair step patterns. That's still strong right now, and this is still in a flag formation. So this is still bullish in my opinion. And I know a lot of people, they only look at Twitter and say, "Oh my God, this is crashing." It's like, well, yes, we got a lot of selling pressure, and yes, it could be crashing. I'd like to see it break through and really change the direction here. I think that the path of least resistance is still up. Although one trading day may or may not determine if we turn or not. So there's my opinion on top of that one. Smart Real Estate Bet says context always matters, and when it is not provided, it's probably coming from someone with an agenda trying to hoodwink you. It says, "Oh my God, 1.2 trillion in credit card debt. The economy is doomed." Me, yeah, but credit card balances as a percent of cash in the bank is around the lowest in 2 decades. Context matters, people. So this is a ratio of credit card balances divided by the household deposits. The only thing I'll say here is I think it depends who has the large credit card balances and who has the household deposits. Because if a whole bunch of people have large credit card balances that don't have household deposits, then this ratio is kind of like, I don't know if that really matters. If the people have a bunch of debt but have a bunch of money in the bank, then it doesn't matter. It's correct. Maybe they bought a bunch of stuff. You know, I recently did a purchase on a credit card. It was for Windows, and I was shopping around because I was going to put about 50% down and 50% I was going to borrow. I was like, oh, what is the percent rate? And they're like, oh, we're going to give you a loan for a large percent. And I was like, well, I could just put on this credit card, 0% APR for 21 months. I'm like, and you can get cash back on some of the cards. So 18 months or 21 months, depending on the cards that you're looking at. And I'm like, well, crap, I could just do that. I still have money in the bank. I still have money to invest. I still have all, dividends and all sorts of stuff. But I don't have to pay an interest rate on borrowed money. So that's that's an example that I did, and maybe I'm part of this to some extent. Here's gold to copper ratio and gold to oil ratio. Look how correlated these two ratios are. And to me, it looks like we were putting in a shoulder, a head, and a shoulder where we could dive lower at some point out in the future. I'm not stating that we're at the absolute top yet, and we could be. We might or might not be. I don't know. But we can also see and make other observations. In history, gold is very expensive compared to copper and oil. You can see here's oil right now is the um, pinkish looking line. And if you go all the way back, I'm trying to think burgundy maybe. You go all the way back, this is really cheaper than everything in history, this oil to gold ratio. Also, copper is cheaper compared to history. So there's a couple of things that we could make conclusions of here. One, gold is expensive compared to copper and oil, looking back at history. Does that mean that gold's going to go down, or does that mean that copper and oil are going to go up? I'm in the camp that copper and oil are going to go up with gold. And I think we're going to see the dollar drop, where if we get a weaker dollar, because the dollar is very expensive, I think if that drops, these will drop back down with it. That is my guess. SRS Rocker report says global economy is heading into a massive slowdown. World copper inventories hit a new high in February 2025 at 614,000 metric tons. When the king commodity is providing a red warning light, get ready for a major correction in global stock markets, according to him. This is the new high. This is inventories going back only a couple of years, though. It's been heading on higher here. And I think that correlates pretty well with the gold to copper ratio. Under certain market conditions, we can see gold go up against copper and oil, and that's signaling the market condition that you are in. That occurred and went high in 2016. It then turned, and we had a big move in oil and copper in 2016. I think that's going to happen again here, just like 2016, 2017, 2018, in that same area. Totally Tankers T Money. It says, do you think it's a coincidence the biggest pumpers in the uranium sector are these people are uber liberals or globalists or vax pushers and are leaving the platform? I wouldn't say that, guys. I mean, why are you going to that extent to make comments about other people like that? I don't have a lot of respect for people who talk about others like this. This is something you shouldn't be doing this, and I don't know. But a lot of people are bullish on uranium. They believe in the thesis, and there's nothing wrong with that. I think uranium's a good bet too. I think we're going into a commodity bull market, and that's when uranium does really well. And I'm invested in uranium as well. But it's not about pumping something. These guys they're posting what they believe to be true, and I don't think that's necessarily being a pumper. If you're going into investments solely based off of people who are talking about it on Twitter and you have no idea what you are doing, it's dangerous. You have to study the sector, study the cycles, study all this stuff. You gain conviction, and you're going to have pullbacks along the way. For some reason, uranium seems to have the worst demographic of holders. They're not. It's not like oil. It's not. I don't know about gold and silver, but some of the demographic, like there's so many people that complain on Twitter about uranium, and I don't know why. It's no different than any other commodity, and it's going to go up with the commodity sector. It will go up when the dollar declines. And I don't know. It's like everyone it gets so mad and tries to blame other people. I don't know why. In the comments section, let me know why the uranium investors are so intolerant of anything. What's going on there? Bespoke says recessions versus housing starts since 1970. A rollover in housing starts has historically been a pretty reliable recession predictor. I actually completely agree with that. This person's looking at the right data. The next thing to look at is construction employment, which would be another finer degree of moving in on the housing starts. The recession generally doesn't occur until you get below a certain level. Looks like this one's occurred pretty quickly, but around 1.3 and below, you got to really start moving below that, and then most of the times they'll backdate a recession there. So we'll see if that actually materializes or not. Construction employment, I think, is a better thing to look at because when that starts to roll over, for sure, there could be a problem. Peter Lynch says you only need one or two good stocks a decade. You don't need a lot of action. He's talking about asymmetry. You only need one or two to go up a whole bunch for you to really win. Some people I was reading below that, they're like, well, it depends how much capital you put in there. Guys, some of the richest people in the world, they only had like one or two stocks that just ran on them and they just never sold. They had 1,000, 2,000, 3,000, 10,000 baggers. 10,000 times your money. No matter how much you put in there, you made a lot of money. Some of these guys, they became billionaires off of one stock. And you basically could have took all the rest of their holdings and the returns were basically minimal. Warren Buffett, there's like 12 companies that he killed it on. And if you took those 12 companies away, basically they would have had just mediocre returns. So the thing that they did right is find, that they found, 3, 4, 500 companies and they stuck with the really good ones and they just never sold. And the returns all came from those 12. Here's North Star. This ain't going away. The Dow to gold ratio just gave its fourth collapse signal in the last 100 years. It doesn't mean it's imminent, but the course is set. Please do not ignore it. And this is Dow Jones versus gold ratio breaking down below critical support that he has here. So what does this mean? Like, gold's starting to outperform the Dow Jones. What does it mean? It means that we're entering that commodity bull market that I'm talking about. This is the super cycle. The ultimate cycle started in 2000. It pulled, and then in the middle of this big, huge cycle, we've got a move up. So this is kind of like an A, B, C correction is the way that you would view it. Kind of like this one here. And we have a long way to go lower. I mean, a really long way. So that means that we have a huge runway of potential outperformance of not just gold, but of commodities in general. He says huge gold bull era and stock market crash. It's likely to take many years to recover. Whilst it's recovering, precious metals are expected to massively outperform. That's what he has in his opinion, which I agree with. The equal weighted SPX continues to plunge priced in gold. So does the Wilshire 5000, Russell 2000, New York Composite Index, and Dow Jones. SPX and NASDAQ will follow. And the worst crash since 1929 is a realistic probability. Now, I don't know if it's going to be as bad as 29. What drove the crash in 1929 was a deleveraging event in the banks. So the real estate market in the mid 1920s was very strong, and all that money that was created in the banking system for monetary bank lending basically went bust late 1929, 30s, and that was a banking crisis. I don't think that we've got the same loans in the system. In the mid 2000s, they were doing the same type of loans as the 1920s. But we could have a banking crisis because there has been basically no reserve ratio put on it. So maybe they're over leveraged. And any sort of move to the downside could disrupt the banks, but it wouldn't be a deleveraging event. It would be a banking problem. So it's not the same. It's not a real estate crisis. So what I would say is, yes, we're starting the capital rotation where money's going to start to flood into commodities, precious metals, and it won't be just a steady stream. There's going to be pullbacks. You can see these upward facing rising wedges, and then eventually we'll create a bottoming pattern. This is a double bottom here on 2009 in 2011, 12. This is where you go long in technologies right here. This is where you don't want to be in tech, or SPX or whatever you're looking at. This is where things are going to break down and we're going to have a big commodity bull run. What he has here is $2,800 gold, 5,000 gold, 8,000 to $12,000 gold. That makes sense. And then it will bottom at some point down here with some sort of pattern. Then we get long in tech, an S&P 500. Maybe it's other companies, depending on what you like. It could be food and beverage companies. That's kind of what I like. I like insurance and food and beverage and all those ones. I'm not so much a tech guy, even though I take a little bit in tech. Not a huge fan of it, but this is going to be driven by a weak dollar. A weaker dollar is what moves gold up, and then money flows out of the stock dollar denominated stock markets. Logan says 2025 new listings data this week, 53,861. What it was the week in 2009 was 278. 2010 was 300,000 and 2011 was 341,000. So we have super low listings compared to what it was historically. This is not a stock market crash. This isn't what it looks like. This is just super low listings. If we were flooding the market, it's got to get way up. I mean, we got to triple, quadruple, or more. Probably. I mean, this is like 7, 8 times. This is 7 times more, roughly speaking. Brady says sometimes all one needs to know is one trend line. Both gold and silver are still respecting these parabolic trend lines perfectly. Slingshot parabolic moves in play, 4-year patterns that are stair-stepping up. These are still very, very good-looking charts. And there's gold and silver 4-year parabolic bases. This will also drag, I think, all of commodities up. I'm in the camp that oil is probably going to be the best play. Oil, gold, and silver, and platinum. Those are the ones I like, based off of the conditions that I see coming. Patrick says stock markets to hibernate for a decade. Dow Jones is squeezed at historical resistance and rising support. Momentum has been lost and at risk of a more pronounced failure. And this is a pretty big move here. And then you can see the momentum, the cycle. These cycles here do correlate somewhat with the commodity bull markets. Commodity bull, commodity bull, commodity bull. And then we've lost momentum and it's starting to break down. This is exactly what I look for in the commodity bull market. I'm just using their charts. So yeah, it's all there. The cycle is turning for commodities. And that's the companies I try to focus in on. Now we are real low and real early in this market because we're just starting to break out and people haven't noticed yet. They haven't noticed yet. It's like breaking it back. This broke here in 2001, the first kind of breakout there. This is kind of back in 2020 where it first started to break down. And we did a lot of chop in the beginning here. This is where people don't believe. This is the whole disbelief phase of the commodity bull market, the disbelief phase in uranium. And we're still in it because we might get a little bit of a slowdown in the overall markets and it pulls back the commodities with it because everyone is so leveraged over in Mag 7. So when this unwinds, it could be bumpy and rough in the beginning and people are going to disbelieve the move. We are still super early in this move. And when we draw this all the way down, I mean, guys, I don't know how to explain this to everyone. The moves are going to be incredible. This is how you can 5, 10, 15x your entire portfolio, depending on how much risk you want to take. Now, there are ways, the whole point in this bull market is to play it with reasonable risk so you capture the move. You don't want to go gangbusters in junior companies with 100% of the portfolio. I don't think that's a smart move. But if you can capital allocate across and just capture the move with pretty good risk, with pretty low risk, I think it's going to be life-changing gains. Now, some people are going to say, well, I want wife-changing gains, not just life-changing gains. I was like, well, you could do it, but you're going to be riding the line between probability of success which means you're going to have to take on more risk, and you could lose a couple positions. And that's what you're dancing on. And it's okay to dance on that line. I'm doing it. I'm dancing on the line with a good chunk of my money. But I'm doing it with certain attributes in companies that I'm focusing on while doing this. Okay, we already went over that. Coming back, here's another Grady chart. Silver's now on a mission back to all-time highs, and this time silver will break out of a 45-year cup and handle. So the overshoot this time around should be massive, maybe reaching $60, $70. I agree with that. And then you'll get a back test of the big pattern. Very big picture. Silver's doing great. Uh, it's climbing the right side of a massive handle, and it is in catch-up mode. Both metals resume their secular bull markets with the dashed lines breakouts. If one does not have patience with a magnificent, truly historical setup like silver has now, one needs to do some serious soul searching. Here it comes, boys. Gold and silver. We're gonna be ripping. We're already in the move. Joe Greenblatt says the important thing is to not get caught up in emotions. Knowing emotions exist, but not getting caught up, being cold, hard, and calculating on valuation. That is the secret. Valuation. It's the cycle. Cheap stocks, cheap commodities. You invest in commodities and then you ride it all the way down. You invest in stocks and ride it all the way up. The valuations are cheap here for stocks and the valuations are cheap here for commodities. And that's how the value investors can always win. You never buy overvalued stuff. You always buy undervalued, which always puts you in the thick of the cycle. Freddie Mac says there's a U.S. housing shortage. Do you agree or are you calling BS? There is a housing shortage, but affordability is having an impact where it's slowing down home sales. So there's a shortage, I agree, and we have a long way to go in the shortage of building homes, but the affordability is having a problem. So I don't think we're going to have a crash in the housing market. Like, I don't think we're going to go into some hyper supply phase and the market's all done. I think we're going to have a slowdown. They're going to lower interest rates and this will come and the housing market will come back. That's my take because of the deficits here. And also because of where we're located here, which is also part of the housing cycle. We've got a ways to go. Those are all interconnected. So just one question: where's the growth in oil production going to come from? I started laughing at this. I'm like, I don't know. Like, I don't know where there's huge growth out here. There's two big things that you want to watch in the oil market. One, you want to watch shale oil. Two, you want to see when it rolls over, because if it rolls over, I think it's lights out. Oil's going way higher. I mean, way higher. And then if oil starts going way higher, you're going to have a spike in interest rates, and then you're going to look at your currencies and say, why would anyone buy bonds? They're not. So you're going to get a spike in interest rates, and then the spike in interest rates is going to have a problem with your currency next, because they're going to try to save the bond market, and they're going to destroy the currency. That's the cycle. And gold and silver are going to absolutely put in 45-year cup and handle patterns where they just rip. I mean, rip. That's the setup. And I don't think anybody understands that. So oil's the driver of all of it. Oil's the driver of a lot of these cycles that go up and down here. What happens is companies, they struggle to grow, interest rates go up, they can't borrow money, money starts to rotate into hard commodities because we've underinvested in oil and all this other stuff, and it's part of the cycle. 1970 was the peak of American production in supply. 2000s was the peak in conventional oil, and now we're hitting the peak in all oil produced in the world. And this is going to probably come down now. I don't know if it's going to be a game-ending move. I don't know. It could be, because I don't think bond markets and currencies can tolerate this type of move. They might struggle. I don't know. We'll see. Because when you carry this amount of debt and you get interest rates, when this comes down here, interest rates are going to go way up. They're going to go up 10, 15, 20%. Can we handle that type of interest rate? I don't know. Maybe the system will blow up, and that's the great reset that everybody talks about. It's all interconnected. I think that's. Oh, this is lots of international stuff popping up. This is Kuwait, I think. iShares Kuwait breaking out, and that's your weaker dollar, though. That's Kuwait versus SPX. It's all currency exchange rates. It's all it is. All of it. Money rotating out of the S&P, and then you'll see emerging markets go up. You'll see gold starting to break out against all these different things. It's all currency exchange rates, and oil. Uh, Oil is not a driver right now, but it will be in the future. And then gold, we're in the part of the cycle where we get a little bit of a slowdown. Gold starts to rip. They're going to probably print money at some point. You'll see the M2 money supply really start to increase. There it is going on up there. You can see it going up vertical here. Yeah, that's all part of it. And that's all interconnected there. So that's where I'm going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Specials, the coupon code. And we'll catch you guys next time. This is Finding Value.